It's the Joe Simon podcast coming at you in three, two, one. Here we go. And this week we're talking about a power tool in the financial strategies world. Uh, it really is known as life insurance. It really isn't known by many, even people that do other things in the area of financial strategies, advisors, accountants, attorneys, business people. It's really a misunderstood financial power tool. And we're going to get into that today, right here on the Joe Simon podcast. This podcast isn't for everybody. Uh, it might be for you today. We cover topics that sometimes are the blocking and tackling of financial strategies, and other times with greater depth and width, an overlooked conversation. So today we're picking one of those, and it happens to be around this financial power tool known as life insurance. And it does come in a lot of different shapes, sizes, colors, so to speak. And we're going to look into some of those today just to give you a rundown of what you can expect on the show today. Uh, who is this for? It's for married couples with kids, for single parents, stay at home parents, empty nesters, retirees who have an estate that might be looking at as much as 45% of that estate being taxed once both are deceased. More on that. And it's also for Main Street USA business owners, where our heart is at. There's so many people that begin in their basement, in their garage, on Main Street, leasing, renting, borrowing, and 10 years, 20 years down the road, they really have something. But in a way, they're kind of stuck. They didn't do the planning, or they're looking for the solutions for where life brings them today in this marketplace that we have, that we live in, and that we must be flexible and pivot around. We'll address some of those thoughts here today, so buckle up. um, One of the things that I want to talk about quickly is the solutions that this financial power tool provides. It's a large financial gap protector with certain tax-free elements to it. It can provide living benefits. So a lot of people think of life insurance as something that has to do with death. But what happens if you don't die when you thought you would, and it's still in place? Well, there's some powerful things that can be used with today's product design that we'll put under the banner of living benefits. Also, as far as business preservation, if you're a business owner, listen up to this uh, for the next few seconds, and that is you might have a buy-sell agreement if you have a partner. You might have that financed with life insurance to provide the guarantee of the buyout of the deceased partner to their family. Um, is is that up to speed with where the value of the company is today? I use the word picture, the hypothetical situation of a business 10 years ago, now 20 years ago, and maybe 2 or 3 years into that life of that Main Street USA business, you bought a nice big fat life insurance policy for each partner. Everybody should be taken care of the right way. If there's a death of one of those partners, it's based on the value of the company, etc. Well, let's say that was in the 2 or 3 year anniversary of that business. And let's say that business now is 20 years old. Do you think the value is still the same as what it was 18, 17 years ago? Do you think there might be some catch up that needs to be provided here with upping that value of that guaranteed financial flow of life insurance death benefit to the through the existing owner to the deceased owner's family? When was the last time you checked on that? When was the last time you make note of that in your journals to keep up with the valuation of what your business should be at today? that is a whole nother podcast we could be talking about. But these are the things that come up when we look at some of the basics 101 and 201 of this powerful financial strategy power tool, life insurance. It all goes under that. A lot of people don't realize that the death benefit, when it's personally owned and directly to a beneficiary, remains tax free. So I have $1 million life insurance policy on me, and my spouse is the beneficiary. At my death, she would receive $1 million of death benefit from that life insurance policy tax free. Powerful. I don't mean to overuse this word, but I don't know of a lot of words. Awesome, amazing. Uh, One of the most lopsided contracts in the world, if not the most lopsided contract. And here's what I mean by that. If I, as the owner, pay for that $1 million policy once it's issued, I have a contract with that life insurance carrier, and they say, Joe, you pay us. We pay your beneficiary at your death as long as you continue to pay out what you've committed to in this contract called the policy to you. That's it. It's pennies for dollars. It's a couple $100 for a few mil or $1 million. Think about that for a minute. What a contract. I'd enter that contract any day. I win, my family wins because I've got myself covered, my business covered, my estate covered. We'll talk more about that today. I just can't say enough about that because I've walked this road before with other individuals, with other business owners, where the policy actually does what it was built to do, and that is pay out at the final chapter at the death of that insured. So let's take a break for a second and pause on that subject we just spoke of. And does this story sort of resonate with you? Great, you have life insurance in place. Is it the amount you need today? Do you have the beneficiaries? Underline that. Are the correct beneficiaries the ones who will receive the money at your death tax free? Or perhaps there's somebody else still noted on the policy, never changed, who legally will be the beneficiary of your death benefit at your death if you've not made the change. This has happened before. We've seen this happen before. I've had a situation, the one that immediately comes to mind was the employer offered $35,000 of term life insurance to every one of their employees. There were about 90 to 100 employees. Many of them were young men below the age of 30. This was the only policy I found out that most of the men, all of the men that I talked to personally when we were filling the paperwork out, this was the policy that they had. There was no other life insurance policy that maybe it was 9 or 10 of the men I personally spent a great amount of time with out of these 90 to 100. Every one of them in the mid 20s had no life insurance on them except this 35,000 that their employer was offering. Moving quickly forward, one of them died 2 years later in a snowmobile accident. I received a phone call from his parents indicating this. He was 27, 28, single. However, he had a daughter with a woman that was not his wife, his girlfriend, and she was the noted beneficiary. But remember, that was 2 years ago that we filled that paperwork out. And guess what? He had broken up with this woman. And according to his parents, she was very irresponsible, not involved with his 2-year-old daughter now and her life. His parents, the deceased employee, his parents were taking care of the 2-year-old daughter, and they wondered what type of life insurance they had to take care of his final expenses. And what happened there was the former girlfriend was the beneficiary legally of this $35,000, tax free. And that's the way that could be. There was no disputing that. So, underlined several times, the importance is when was the last time you made sure your beneficiaries were the ones you wanted on these big tax-free payouts that many of us have on our life today, not only personally, but business-wise. So that's my beneficiary lesson there. What I really want to direct our attention to at this point is the living benefits. So everybody understands that life insurance is for death. Um, I like to say life insurance is for death and for those people that you love that are left behind. It's probably one of the most ultimate love notes that you could leave your family. I'll let that one just sit there for a while. But besides the death benefits that everybody quickly understands, what some of us need better understanding of is what I'm going to call the living benefits within this life insurance world. And these have really come to fruition in, let's say, the last 20, 25 years, where you can actually use a life insurance policy for other things while you're still alive on your life. But remember, you're still alive. The quick one is if it's permanent life insurance, the accumulation, the growth, the cash value within this policy is borrowable. And as long as you borrow from the policy, it's a tax-free maneuver. So let's say you have this policy, it's growing at 4 to 5 or 6%. And over time, you've been earnest in putting in the premiums, and there's a nice cash value that's accumulating. There's numerous things that you have access to without anybody restricting you from this, without any tax penalties, without any age limitations. Now, it depends on the type of design in the life insurance policy, and I would suggest that you talk to your advisor, your agent that put that in place with you at that time. Things change, but I need to say that if everything that you saw and worked on with your advisor with this, there's a very, very good chance, very good opportunity, I should say, to get into this and find out how the flexibilities of this are with that cash accumulation for the living benefit, paying for the expansion, the addition on your home, taking that once in a lifetime type of vacation or trip, educational purposes, gifting to grandkids. There's many things that you can do with that and get creative with and have the flexibility to do. It's quite a enjoyable type of thing to realize that you have access to that. But let's get into the more serious side of what living benefits really represent. Terminal illness, long-term care, supplement to a retirement, deferred compensation for key people or a business owner in a business, chronic illness, estate preservation. These are many things that come to mind that you have access to using when it comes to this permanent type of life insurance. There's a few different types of chassis or designs that could be put in place, but a big door opens when these life events occur and you discover, hey, I've got 50,000, 75,000, $125,000 in cash or more that I can get at for different things. I want to buy a business partner out and I have $125,000 in cash accumulated in my permanent policy. I don't need to deal with the bank. I don't need to deal with what my financial situation with my business to prove to the bank that I'm a good risk to get $125,000 at whatever the roaring or the current interest rate is at. You can finance yourself with a large portion of that as a down payment, as a payment off. So isn't it nice to have choices, financial choices, to have this kind of flexibility? What I want to zero in on uh, with this short list that I just mentioned with the living benefits, let's just address these fairly quickly because I'm finding that most people really don't understand the definitions of these options that you can build into or are automatically built into policies today. The first one was terminal illness. If it's detected and you have a doctor's affidavit that says you're terminally ill and your policy allows this, or it has a rider built in, you can actually get at, let's use the $1 million life insurance plan design that I'm using earlier. You can get into that $1 million death benefit before you're dead to pay these costs that are mounting during the terminal illness of the insured, tax free. Yes, granted, let's say it's $100,000 that is used for terminal illness expenses. That's subtracted from the $1 million death benefit. But perhaps that time in your life and your family's life is when you really need that financial relief, that financial stress reliever. There's many things that come from that. Again, choices. It's nice to have. What about long-term care? We talk long about this big issue. And in many life insurance policies today, a rider can be built in to protect you and your family from sort of an unknown, an unrealized potential leak in the financial boat that is necessary when long-term care is needed. Same idea there. The death benefit uh, can be used for qualified long-term care expenses subtracted from the death benefit. And again, $100,000 from that $1 million policy leaves you with $900,000 of death benefit at the insured's death. But there may be a need for that money up front. It may be an ongoing many years type of situation. And many of these policies will have a little speed bump on that. For example, they'll put a limit on how much of the death benefit can be used for long-term care. I've seen it around 50%. So in this case, the $1 million becomes a $500,000 long-term care option financially to pay some long-term qualified long-term care claims. Um, a supplement to retirement, that one's very simple. Cash value buildup in your death benefit or your life insurance policy. There's a limit of what you can take out. Generally, it's around 70% of the cash value before the balloon called the policy would implode and say, we need some cash value to keep the policy alive. But as long as you have that minimum amount of cash value in your policy, another option for you, good things are happening in your life, happy plans are being made, and man, if we only had that extra $25,000, we could really make this happen. And you find out in your permanent life insurance policy, there's more than that in there that you could use to conclude the plans that you're trying to make during your healthy, happy life where you're looking at maybe a dream home, a dream edition, a dream trip, a need for additional dollars to buy a vehicle. Lots of things from that. I think you get the idea. Chronic illness is another one of those. So it's determined you have a chronic illness and you're going to die in a year or two. It's determined by the doctors that this is chronic. This is communicated with your life insurance policy carrier. And as long as there's two of the activities of daily living that you cannot perform, this will qualify for, again, access to death benefit while you're alive to pay for those expenses, sometimes unnoted, sometimes way beyond your financial capabilities. And it's a shocker and it's stressful, and family members have to get involved. So we want to look at that chronic illness rider in the policy. So let's quickly turn for just a second back to being a business owner. One of the things that we realize when it comes to that Main Street USA business, let's say you have less than 250 employees, closely held. The decision makers are in and out of the business all day long. It's easy to find them. They're not in some remote high uh, skyscraper building in a major city here in the United States or overseas. They're here. They know what it's like to turn the lights on in the morning and turn them off last person at the end of the day. That's the kind of business owner I'm addressing right now. I like to call them Main Street USA businesses, business leaders. Um, so what we know is when we have qualified plans like a 401k or a simple IRA, those are qualified plans. Everybody must be treated the same, have the same understanding, same access to these retirement planning vehicles provided by you, the employer. However, there are some people, including yourself, that you want to do something extra for above and beyond those qualified plans. So that's where we turn the page and go to non-qualified plans, plans that aren't going to give you the tax deduction up front, but still they're captivating, they're sizzly because they're attractive to people like yourself or key people that are looking, they're giving you above and beyond every day. They know it, you know it, you've told them, and you want to retain them or attract other, let's call them superstar people. And I know that might interrupt your thought as far as all of my employees are superstars, but you have, maybe it's the top 10% that really do something more, and the business would be drastically affected if they were gone without notice, including yourself. That's where we look at non-qualified deferred compensation. Life insurance can be used in that. That is a tool that does many different things for you, your business, your employee, that employee's family. Again, non-qualified deferred compensation is, because it's non-qualified, it can be tailor-made and selective for certain people, including yourself, at the business. It's phenomenal. Many conversations are around that. And typically, what we hear in the first go around is, I did not know we could do that. I did not know what kind of, what do you call that life insurance plan? And the basics of it is it's a life insurance policy. But what we do around it with the documentation and the purpose of it is a lot different than your typical, what I would call vanilla shaped life insurance policy. Greater discussion needs to be had if this is something you want to know more about. Non-qualified deferred compensation on your key people. Let's quickly pivot over to estate preservation. This is interesting conversation, and really maybe 2 to 5 to 10%, maybe at the most, of people are concerned about the preservation of their estate right now. However, what I want to do is sort of capsulize where we're at today and where it could go back to shortly. So we work very hard at building our assets and our properties and our business and all those things that have value around it. But what we don't like to spend a lot of time talking about, because it seems so far off, is what happens when you, and if you're married, your spouse, are now gone, and we have this estate that somehow comes back to you. So what we know about the estate tax thresholds right now is that threshold is at $13.6 million. It's a lot. And if you're married, it's twice that, $27.2 million. So you say right now, you throw your hands up and you say, that's not me. But listen to this. If this estate tax sunsets, it's planning to at the end of 2025, those values could go back down to what they were pre-2017, and that's 5.6 million, or about 11 to 12 million dollars in estate value. Now, that's a game changer. You put in the value of your house, your 401k, a couple properties, maybe if you're a business owner. It doesn't take a long time when you put you and your spouse's total in there, maybe an unexpected gift put in there. All of a sudden, we're at $5 or $6 million in estate value. And here's my concern. If there's a lot of ifs, but just play along with me for a second. If the estate tax thresholds, as we know it today, the couple paying with an estate over 27 million, who is concerned about what their taxation could be at that point after, and it's going to be a lot. But let's say those thresholds change and they go back down to that pre 2017 threshold of just over $5.5 million, that is a game changer that should get all of our attention. And what happens at the overage over that threshold is taxation. We could call it a death tax. You're not there to defend yourself any longer, and the federal government is there with their hand out saying, and we'll take our share of that, and it's going to be taken out of the value of your estate. And by the way, the clock is ticking and we want it paid pretty quick. And we don't do deals. We want a lump sum quickly. So this is another role for life insurance. I know it's amazing. So we place this life insurance in order to cover just the estate tax of the whole thing. We might involve an attorney who puts together a certain type of trust that preserves the value and has the life insurance in that to come out and pay directly what the estate tax is. I know some people are saying this is crazy. You're buying a life insurance policy to pay federal tax? Absolutely. So imagine with me, you have a $15,000 estate tax, estate value, and now the estate tax changes and it's down to 11 and a half, 12 million dollars. So anything over that 12 million, in your case, the 3 million is subject to taxation at the highest levels. A $3 million bill is owed by you to the federal government. I hate it. I hate paying that bill. I don't like it. Well, you've got a choice. Where do you want to get the money from? Do you want to sell? Do you want to force your family to sell possibly your favorite hunting property, possibly the family cottage, possibly the family business, other things? Where's the money going to come from? The feds want their money and they want it soon. So this is where we insert various types of plan design in life insurance. And I know every case is different and it's tough to get specific with this one picture for you today. But the idea behind that is it takes planning and it takes looking at what the options are as to how you really would want that last step to preserve your family estate, your legacy in many cases, and how you would want to go about that. The last few minutes, I want to talk about plan design within this, and just quickly, a couple of things to check on. Does your current, so you have term life insurance, does your current term life insurance allow an option for you to convert the policy? What that conversion rider allows you to do is convert that $1 million life insurance policy to something that has permanent value. It allows you to put more money in and enjoy that tax-free buildup of cash in it without underwriting. This is typically something that we would want to look at when you're younger and money is very tight. You need the death benefit, so that's the number one objective. But the plan is someday you'd like to have some cash accumulation. So we sort of have that exit door built in that says, here we are, it's 7 years later, and now you can afford to convert all or a portion of this death benefit without underwriting, regardless of your health status, to a more robust type of way to accumulate some tax beneficial dollars. So check your policy, make sure you have a conversion option in there. Um, Here's another one that we've used in the past, and maybe you have this and you don't even understand it now, but using that $1 million life insurance need, that's the need. We're trying to meet the fact that there's liability that needs to be covered and it's $1 million. We put the policy in place, but perhaps you're somebody that can afford just a little bit of having a policy that would have some permanent value, some cash accumulation, but not all of it. Let's say it's 50% and the $1 million policy is being built. How do we do that? What would be one of the options that would be interesting to look at? We could layer that. We could put in with the same carrier in some cases, maybe two different carriers, $500,000 of a permanent policy and $500,000 of a term policy. So that's the foundation. And then we can determine how long do you need this $1 million of protection. And let's say you say that's for 10 years. 10 years. So what we may want to consider is building that term policy portion of the million to last for 10 years. And building the permanent policy, the other half of that $1 million, for you to contribute premium for 20 years. And then it's paid up, and then it lasts forever as long as you do what you say you'll do. And so we look at that, and what we see is 10 years, policy cuts in half. Moving forward, you continue to pay premium to the other half of that. And at the 21st year, there's a nice cash accumulation of tax-free, tax beneficial dollars in there, and you still have a $500,000 life insurance policy. That's one technique we use when it comes to layering. So it's almost time to come to a conclusion. I want to take the last couple minutes here just to we've been working in this this quiz provided. It's called the Retirement Income Literacy Study that the American College of Financial Services has out there. We can get the link to you, and I can give you information on that at the end of the show. So stay tuned for that. But just a couple quick questions to see how sharp you are today on this subject that we're studying, talking about. And this again is from the American College of Financial Services in their quiz. One of the questions is, which one of the following is true about permanent life insurance? The cash value portion will accumulate tax deferred. The policy will expire after a specified period of time, or the policy will typically cost less than term insurance. And the answer is the cash value portion will accumulate tax deferred in this permanent policy. Last question for today. True or false? True or false? The death benefit from a life insurance policy owned by an individual is income tax free for the beneficiary. True or false? Or I don't know. What do you think? It is true. The death benefit owned by the individual to the beneficiary is tax free. So that's about it for today. I really appreciate your time. What we try to do is really zero in on a couple things that are often overlooked when it comes to your financial strategies, things that I've picked up on over the years. This is a marvelous financial power tool, this life insurance. I've personally seen how it's been the glue to businesses, to families, how it's saved businesses, how it's really kept families on the middle of the road rather than in the ditch financially. If you want to know more about this quiz that we just took, provided by the American College of Financial Services, or if you have a comment for me, if you want to know more about Social Security, if you want to know more about some things that exist right now that you're participating in and you want to share some thoughts, you can always get a hold of me at jsimon@davinciinsurance.com. Again, that's jsimon@davinciinsurance.com. Thank you for your time and have a prosperous day.